There is a change in the Foreign Exchange Management Act guidelines as well, which have left certain mutual funds in a tough spot. The new rules, which were notified in October, affects foreign-owned or controlled mutual funds operating in the country. Payaswini Upadhyay joins us right now to talk about how these mutual funds get affected by this change. Payaswini, I'm sure people are trying to figure out a way around this because these rules seem like a bolt out of the blue.
Yeah, they are, Neeraj. So this is owing to the FEMA regulations that were notified on October 17th, which is last month. And they broadly make a distinction between domestic mutual funds or domestic owned mutual funds versus foreign owned mutual fund. And the distinction has come in by way of a change in definition under the FEMA regs of investment vehicle, which earlier included entities like your alternative investment funds or AIFs, REITs or InvITs. Now, the investment vehicle definition now says that it will include mutual funds which invest more than 50% in equity. And I'll come to, the confusion around more than 50% in equity as well. Now, what is the change is that, now, the investments by these foreign-owned investment vehicle, which now includes mutual funds, get categorized as indirect foreign investment. So the moment there is a foreign investment in an investment vehicle, any investments in the Indian market then get categorized as an indirect foreign investment. And the implication of that becomes that they now become subject to FDI restrictions, whether it is sectoral caps, entry routes, automatic or government approved, or your entry, your pricing guidelines, etc. Now, what the new regs also say is that if their sponsor or investment manager of a mutual fund in India is not organized as a LLP or a company. So let's, for instance, say, Mere Asset Management. If the sponsor abroad is organized as a trust, SEBI will have a discretion to determine whether or not the entity in India should be considered or categorized as foreign owned. Now, the implication of this, all of this is that, a bunch of, your funds like BNP Paribas, Mirae, Franklin Templeton, HSBC and the likes will now have to check when they're investing, in an equity, in the equity market, what are the sectoral FDI caps, applicable to the sector that stock belongs to. There are onerous reporting requirements that come into play the moment your investment gets categorized as indirect foreign investment. Now, I believe and reportedly a bunch of these mutual funds have approached SEBI, to do away with this, artificial distinction that has now been brought in as a result of this change in definition of investment vehicle under the FEMA regulations.
Payaswini, I just have a follow-up. Did anybody in the legal circles, and I don't know if you had a chance to talk, but there is a slight distinction that prima facie comes to my mind. Unlike an AIF, which invests investors' money and foreign investors' money into Indian stocks, out here, these quote-unquote custodians, any AMC which might be foreign owned, in large proportion invest Indian investors' money into Indian stocks, and therefore there is a wide distinction out there. Are legal voices saying that there is out there quote unquote a loophole which they might seek adherence to and then try and convince or try and make a representation to SEBI or the Finance Ministry for bringing about a clarification?
So, Neeraj, the language of the regulations is pretty clear that if you're a mutual fund which has a sponsor which is a non-resident Indian, and you as that mutual fund are investing more than 50% in equity markets in India, you will then have to comply with the FEMA regulations. So there is no sort of getting around it unless there is a specific clarification that comes to the contrary, and the language of the regulations is amended. The other sort of confusion that's prevailing in the market is the definition says that 50% in equity. Now, this 50% in equity, AMCs are unsure whether it is to be considered at the fund AUM level or a scheme level. So let's say, Mirae has an overall portfolio of 10,000 crores. Now, do you consider, Mere Opportunities Fund or a Mere, their lead equity fund, and then basically apply the FDI restrictions based on that scheme? Or will it, be considered at a AUM level? In which case, we'll have to do a quick check on the NSDL data. But a lot of these funds, their debt exposure is higher compared to the equity funds. I don't have the figures offhand. So they may sort of conveniently be, out of the restrictions that the FEMA regulations now seek to bring in for them. But the moment your equity exposure, if it's to be considered at an AUM level, is more than 50%, then you're in the regulations. If it is considered at a scheme level, then it's even more problematic for these AMCs.
No, Pasini, I can tell you with conviction, Nippon Life, for example, the ex-RNAM or even the current RNAM in terms of stock price parlance, but their equity exposure some years ago used to be 85%. They've brought it down, but it's still about 57%, and that's a large number, a large AMC, HDFC, a large AMC, which I presume has also over 50% of assets in equity, so or equity assets under management. So this will be really bad for the AMCs themselves, I dare say for the markets as well, if this were to be the case. Let's wait and watch what happens. But Pasmini, thanks so much.
If I can also bring in a complication in terms of, since you mentioned a reporting requirement. So let's say HDFC and the foreign investment in HDFC is capped at 75%. So now if these foreign-owned investment sort of funds want to invest in that stock, they can't. The other sort of problem is, let's say and assume there is a stock at which it is at 72%. Now, once my investment gets qualified, I have to report to the RBI that I have made as a foreign investor an investment in this stock, which is in this particular sector. The system that reflects that the foreign shareholding in a stock has gone up takes about 2 days to reflect. So now no new reporting can be done in that stock unless that the system reflects it. So now this process currently, AIFs, REITs and InvITs were going through this compliance process. Additionally, now AMCs, which are foreign owned, will also need to keep checking the equity levels or the foreign shareholding levels in individual stocks in the Indian market.